Yeah, I think a recession is already here. So everybody is talking about this upcoming recession. When's it coming? When's the probability? Here's the thing. I think the recession's already here. First quarter GDP was negative, and with rising interest rates, high inflation, and a war in Russia-Ukraine, we now have a much more challenging environment than we've had in a very long time. And on top of that, the housing crisis looks like it's getting worse, which is what we'll talk about today. But I want to make it perfectly clear, I'm not that bearish on the stock market, publicly and privately inside our investment community. I've talked about how I'm cautious, of course, but I do see opportunities in select pockets, and our research was able to pick up Alibaba and AMD both at $85 a share. So being super selective right now and getting rewarded for it when the time is right. If we're meeting for the first time, welcome. My name is Larry, and I'll be your investment strategist where I talk about US and China macro and equity strategy. While I do spend a big portion of my channel talking about the stock market, I see the housing market as an important proxy for consumer health and confidence. Housing is typically about 50% of US household net worth, so it's incredibly important to follow. And just a quick thank you to our sponsor today, FTX US, for sponsoring today's video and my channel. More on them soon. And make sure you're on my email list where every single email that I send out is value-packed, thoughtful, and insightful. Now, over 3,000 people now read my periodic notes, so come through. Now, let's get started. I'm going to cut straight to the chase and say that the US housing situation has gotten a little out of control. I recently did a poll on my YouTube community tab about rent prices going up this year, and at least 35% of people say that rent went up by at least 4%, with 25% of us saying that rent is up 7% or more. And I don't know about you, but unless you are your own boss or you are working at market-leading firms like Goldman, Bain, and Google, you're probably not getting a raise of 7% or more. So the market for rents has gotten a bit crazy. Let me run the numbers for you. There are a number of real estate brokerage firms out there that give data on rents, Realtor.com and Redfin. Here's what I found. Rent prices on average went up about 17% year over year. New York, in Manhattan specifically, up 23%. Here in Boston, up 20%. Chicago, which is known for reasonable cost of living, up 12%. Seattle's up nearly 20%. San Diego's up 25%, and Miami's up 30%. Now, industry experts and the New York Federal Reserve say that they expect rent will go up about 12% in 2022. So here's the big picture situation. We have a real estate market where rent now eats up about 30% of household income in the 50 metro cities in the US. And when you have rent being such a high percentage of income, it makes it very, very difficult for millennials to save money to buy their first home. But all things considered, if we do want to feel better about the situation here in the US is better than it is in Hong Kong. In Hong Kong, rent eats up about nearly 50% of household income. Now, I have quite a lot of Patreons from Hong Kong. Hopefully my investment research helps them make more money. Now, back to the discussion of home ownership, we now have mortgage rates at above 5%. And last year, it was in the 3% range. Now it's above 5%. So that means most homeowners are most likely going to hang on to their homes and not sell their current home and buy a new one, because that would be trading a 3% fixed rate for a 5% fixed rate. And who would want to do that? And also, since home prices have climbed across the board, selling your home at a higher price than you bought it for doesn't mean that you have any more purchasing power, because all home prices have gone up. So it's like a wash. And as a very simplistic example, let's say that you took out a $300,000 loan at a 3% 30-year fixed rate. That's a monthly payment of $1,265. That was the monthly payment that people could expect last year. But if you're a new homeowner today, the 30-year fixed is now 5%. And in terms of monthly payments, it would be $1,610 per month. And if rates go up to 6%, because the Fed keeps raising rates, then it actually is going to go up to nearly $1,800 a month to service both your mortgage and your interest payments. Now, we really do need to smash that like button, subscribe to the channel, and turn on that bell so that rates come back down. So we're in this awkward situation where renters are at the mercy of landlords, with rents going up 12% this year, and homeowners are not willing to sell their existing homes, keeping supply tight, and mortgage rates are going higher, which makes it tough for first-time homebuyers to get into the market. This means there's significantly less activity in the mortgage origination industry, and here's some updated data on mortgages. Layoffs, they're intensifying in the industry because mortgage rates is sharply slowing down loan applications. Mortgage applications are also continuing to drop week over week. Fannie Mae analysts are expecting 889 million in mortgages refinanced, but less than 600 million next year, and that's going to be down 80% from 2.8 trillion in 2020 when interest rates were at rock bottom. There's also a rising percentage of cash buyers out there who are pricing out first-time home buyers who rely on mortgages to finance their homes. And as a result of this macro landscape, we're seeing the following names continue to face incredible pressure: the real estate tech firms Zillow, Redfin, Opendoor, the home building sector directly, and then home improvement stocks like Home Depot and Lowe's. Now, I'm mostly a tech and consumer discretionary investor, so while I do watch housing, I don't directly invest in most stocks in this space. Out of all of these names, I only hold Home Depot because of its duopoly status with Lowe's, as well as its impressive dividend. It's probably the most conservative play in a housing downturn. It's going to be very difficult for companies like Zillow and Redfin if interest rates keep going up, especially when home affordability is already so challenging. So net, with the Fed raising rates with a strong intention to bring down inflation, we'll need to see whether we get peak inflation data before we can see the housing situation improve. And in the meantime, we can expect higher rents and more people getting priced out of the housing market. That brings me to my next point. One very irritating issue that is hurting my peak inflation thesis that the stock market and even the digital asset markets needs to recover. But before I dive into that, I'm going to need to give our sponsor today, FTX US, a kind welcome. If you're looking to buy digital assets from a reputable brokerage, FTX checks off all of the boxes and has one of the most intuitive platforms in the entire industry. They have a complete crypto and finance app that allows users to buy crypto assets and NFTs with no fees, and will soon launch stock trading. One of the best functions of their app is that they allow their users to easily dollar cost average into the market, and given how volatile digital assets can be, this function allows investors to smooth out volatility over time. Now, one of my other favorite parts of this app is that the fees on this exchange are much lower than the other ones out in the market. No minimum fixed fees on transactions. The reason the fees are so low is that the exchange is led by Sam Bankman-Fried. He's publicly announced that he wants to donate 99% of his wealth away. He wants to revolutionize the crypto industry with his leading app. Now, you can use the FTX app to buy your favorite NFTs with no gas fees, and also up to 85% lower fees than other top exchanges. The app also features highly relevant news across the specific digital asset or cryptocurrency space that you're interested in researching more about. For my friends here on YouTube, FTX is giving all of my users who use the code Larry Chung to get free crypto on every trade over $10, but you have to use my specific link and code down below to download the FTX app. Just downloading the free app supports my investment research published here on YouTube, and as always, thank you for your support in advance. With that said, let's get back into the video. Okay, so just a moment ago, I said that there was an issue that might threaten my peak inflation thesis from materializing. And it's the food shortage crisis that we are seeing because of the Russia-Ukraine turmoil. Allow me to explain. First off, we need to know that fertilizer is one of the most important components in agriculture and farming. It's important because it helps to increase crop yields of up to 40 to 50%. The higher the crop yield, the more efficient the agricultural process is, because it can measure how much grain or other crops are produced. Well, right now, Russia is the largest fertilizer producer in the world, and Russia is not exporting fertilizer to countries that are being unfriendly to them. Added with the fact that Belarus, which is heavily influenced by Russia, and Russia itself account for nearly 20% of fertilizer exports, we now have a situation where global food input costs are structurally higher. Now, the USDA estimates that the cost of fertilizer is more than 30 to 35% of input costs for essential foods like corn and wheat. And because fertilizer costs have gone up significantly due to the Russia-Ukraine crisis, farmers are now looking for alternatives like manure to serve as fertilizer. But because of this mad dash for fertilizer alternatives, the price of manure has also gone up significantly, and the equipment that processes it have gone up significantly. So we can see here that the moment Russia-Ukraine make peace, food prices will start to come off from elevated levels. And on top of all this, we do need to monitor diesel fuel prices because diesel makes up about 15 to 20% of farming costs. And right now, diesel fuel prices are actually at all-time highs because of a combination of strong transportation demand as well as production disruptions due to the Russia-Ukraine crisis. So while most media outlets discuss crude oil prices, the truth is that it's diesel that fuels a lot of our transportation infrastructure as well as our agricultural infrastructure. In other words, there are a number of factors right now that are keeping inflation structurally elevated. But I still have hope that inflation is nearing its peak, and with that comes a new set of opportunities. In the meantime, if you're someone who wants to navigate the stock market and the tech sector's recent volatility, take a look at my email list and Patreon below. Lots of insights inside. Hit the like button if you enjoyed this video, share this video with friends and family, and thank you to our sponsor FTX again. Don't forget to sign up for FTX's app with my code Larry Chung, where every $10 trade earns you free crypto. More timely market commentary inside my Patreon community if you want to be a supporter, and I'll see you in my next video.